Okay, sure. Okay, thank you everyone for joining. We are initiating this discussion on based on our research on the role of financial intermediaries in unlocking mitigation finance in India. And just without much ado, I would invite Dr. Debajit Palit to give the welcome remarks for this particular webinar. And I would just take a minute to give an introduction. So Dr. Palit heads the Center for Climate Change and Energy Transition at Chintan Research Foundation. He has almost 27 years of experience working in the domain of renewable energy, energy transition, clean energy access, microgrids, and energy livelihood gender nexus. Dr. Palit possesses vast national and international experiences working in UN projects, bilateral organizations, World Bank, and the ADB. And he has also published 3 books and 150 scholarly papers. With this, I would invite Dr. Palit to deliver the welcome remarks.
Thank you. Thank you, Dr. Ria. So very good afternoon to all. Let me at the outset thank all these speakers and participants for joining this webinar on the topic Unlocking Mitigation Finance in India, the role of financial intermediaries. That has been organized by Chintan Research Foundation. I understand many of you must have been part of our different events that we have organized during the last 1 year. However, some of you might be joining a CRF dialogue for the first time. So for them, CRF is an independent public policy think tank, and we focus on across 3 verticals. The one is on climate change and energy transition. The second is on economy and trade. And the third that we are dealing with is on geopolitics and strategic studies. And the way we work is through research, dialogue, and stakeholder engagement and webinars like what we are organizing today. So as Dr. Ria mentioned, the Center for Climate Change and Energy Transition, we are attempting to advance research and dialogue on energy transition, climate resilience, environment sustainability, and governance with a focus on India and the Global South. In the past year, our work found its way into 7 op-eds, more than 27 research articles, and into 28 conversations, each one attempting to push a conversation forward rather than just add to it. क्या चीज
आप जो बैकग्राउंड आ रही है ना इसे बोल रहे हैं रिवर्स करने के लिए
ठीक है समझ गए so well there are some little bit of problem just a minute. Well, so sustainable finance now, the reason why we are organizing this particular webinar is that sustainable finance is gaining momentum, we all know, as a subject. And at CRF, we have started some work on these subjects, particularly by my colleague, Dr. Sinha, and we have produced a couple of reports during the last month or so, and in the process of writing a few more, including one on financing of nuclear energy projects in India. Now, estimates suggest that India requires nearly 250 to 260 billion US dollar between 2026 and 2030, reflecting the scale of India's transition challenge. However, annual green finance flows currently stand at only at around 44 billion. And I think this webinar probably will try to find answer to some of the reasons why finance is still an issue and how do we increase the finance for this sector. But my personal belief has always been that the money is not a problem. The money is floating around. What is a problem is the ability to absorb the money, one, and two, whether we can channelize the fund to the right cause or not. And that's exactly where I think the climate finance is important for us. And this is where the financial intermediaries such as banks, NBFCs, and others assumes a critical role. And that's exactly the reason why we have tried to undertake this particular work on role of financial intermediaries. Now, India has also demonstrated that mature sectors like utility scale renewable energy, they are attracting a large private investments because there has been policy certainty, viable business model, and appropriate financing structures have been brought together. However, several emerging sectors like the green hydrogen, battery manufacturing, electric mobility, industrial decarbonization, DRE, they all continue to face significant financing constraints. These challenges arise not just from technology risks, but also long gestation periods, evolving business models, which I feel is a very extremely important. My former boss, Dr. Ajay Mathur, always used to say a thing that we first have to work on technology that works. Once that is established, then is the business model that works we have to establish. And after that, once we establish a business model, and then the policy will come into the play. So I fully agree with his view that it's extremely important to have a business model and a bankable business model, and then the policy can take it forward the way it has taken forward the utility scale renewable energy. Probably the business model has not yet been established in case of green hydrogen, so we don't find so many takers, or for that matter, electric mobility, industrial decarbonization, which I feel is the elephant in the room. We have to address that. And if we have to address that, we need the reason why we are still finding it difficult to address some of these things is because of the high upfront capital requirement and the limited availability of long-term finance, because the business model probably is not working. Now, these are some of the barriers that require much more than increasing the supply of finance. And it is against this backdrop that CRF undertook this study titled this Role of Financial Intermediaries to Unlock Mitigation Finance in India, the Challenges and Enablers. I think Dr. Ria is going to discuss more about the study after my intervention. So I'm not going into the details what has been found as part of the study and what are the challenges, what are the enablers, and what is our recommendation. I'm sure she is going to highlight all these things. So in conclusion, I hope that today's discussion moves beyond identifying the financing gaps and instead focuses on actionable solution. I'm sure that we'll get some great ideas from the esteemed panelists. We have tried to get panelists from right from the policy think tank to practitioners to actual bankers, and they will definitely suggest solution that can make climate investments more bankable, scalable, and attractive to private capital. I'm confident that the collective expertise of our distinguished panelists and the insights that will generate by their recommendations and suggestion will definitely create the buzz and create the interest for the audience to remain hooked to this webinar till the end. So before I conclude, I'd like to again express my sincere gratitude to all our panelists and moderator and each one of you for taking the time to join us today. Thank you so much, and hope you enjoyed the webinar and we can get some wonderful suggestion, which again we can use to develop few more papers for the sector as a whole. Thank you so much. Over to you, Ria.
Thank you so much, Dr. Palit, for setting the context. So going forward, we are going to make a very short presentation based on the paper, on the research paper. And then following that, we will have our stellar cast of panelists to join and start the discussion. So just give me 1 second. I will just share the presentation. So We have been hearing a lot of discussions regarding, the shortage of capital, the scarcity of capital in mitigation finance. So when we started this particular discussion, when we started this particular research, like these discussions were already going on. But then as we, kind of progress into the research, we realized that it is more than the capital, it is the accessibility of capital, which is the major issue, and how to kind of mobilize and how to deploy more capital into the climate mitigation space is the major question, and for certain specific sectors. So we started this study because we already had a lot of, climate assessments which have been done by various organizations. And most of these studies, I would say a prominent section of these studies also kind of assess what is the total volume of, climate finance which is required for the different specific sectors. So we definitely wanted to understand that why it is that some of the sectors like clean energy, transportation, energy efficiency, they are getting the maximum volume of capital. But it is the other new niche sectors, I would say, like battery storage, industrial decarbonization, which are struggling to get access to finance. So definitely through this study, we wanted to kind of understand the critical challenges which are there in these specific sectors, explore the specific nuances in this, and understand from the experts who are into this particular space. So what is it that will drive climate finance into the space, not only for the existing sectors which are there, but also for the newer sectors? So for this particular study, the methodology has been extremely qualitative in nature. And the data, of course, pertains to both, secondary reports, which we have from the various sources, and of course, the primary data that we have got access to through the various stakeholder consultations that we have done. So this sampling has been extremely, purposive in nature. And through this study, we have been able to reach out to the NBFCs, to the commercial banking experts, to the specific sector experts who have been in this particular domain for more than a decade or 2 decades. Yeah, and bilateral conversations with these experts, through the bilateral conversations, we have been able to derive some of the insights which is there. But before that, what we would want to start off with is what does the landscape of climate mitigation in India looks like. So majorly, most of us know that it is majorly, domestic capital, domestic private capital, which is into this particular space. Almost 46% is, into this space. And most of the finance which is going, it is going to clean energy, energy efficiency, and clean transport. So what is it with the newer sectors that are there, that they are struggling to get access to finance? And this assessments are there already in the domain. With this, we started on the study, and through a period of almost 12 to 14, conversations that we have had with the experts, these are some of the insights which, come across. So definitely there are quite a number of challenges, both on the demand side, and there are challenges on the supply side. On the demand side, of course, the very first challenge which we come across is the bankability. And here, of course, when we talk about project bankability, many emerging sectors, do not generate sufficiently standardized and investable ready projects. So what are the financing challenges, and what is that which is preventing them from entering into the space? And though the newer spaces like MSME decarbonization, DRE, storage, industrial transition, they are all recognized as very high potential markets, but definitely commercial viability of capital is a question. The second, of course, the second challenge which we see is capital structure imbalances. There is, high dependence of many of these climate-relevant sectors like the electric mobility, DRE, the early stage sectors, they absolutely remain very much dependent on equity. And equity investors, they will want returns as much as 30 to 35%, which is definitely a very high rate of return. And of course, balance sheet financing. But the other sectors, like which are the established sectors like the utility scale RE, which of course benefits from conventional project finance and predictable cash flows, because that's something which is one of the major sources of attractability for the institutional investors as well. The emerging sectors are very much reliant on very less standardized asset pools. The other challenge which we definitely see in this particular space is very obviously the risk perception of the debt providers, because for them it is the viability of the cash flows of any particular project which is one of the determining factors for providing finance. On certain cash flows, like the business models are evolving, the technologies are very niche, they are very early stage technology. So these possess these definitely give a lot of risks, which are very difficult, which becomes difficult for traditional finance providers to apply conventional credit assessment frameworks. So definitely debt is something which is very difficult for the newer sectors to get. Then there are other, the contractual and liquidity risks in the implementation models. And there are payment delays, because working capital is always a very critical factor for any particular project. So when there is a payment delay of like 3 to 3 months, that definitely gives a lot of pressure for the developers. So in absence of these kinds of very strong payment security and the contracts, the lenders definitely perceive these the newer avenues as risky projects. Very importantly, and this has been an ongoing, kind of a discussion which has been going on, and that is the lack of a clear green taxonomy. Like we all know that there has been developments, quite a lot of developments in this space, but still what we see is a draft. We do still not have a green taxonomy yet. And it is not, definitely one of the factors is what is green. And when we say taxonomy, it is a kind of a common naming, like what is commonly understood by all stakeholders. So definitely what is green and what is non-green has to have a very common paging across the various stakeholders. But apart from that, very importantly, India's transition will depend majorly on the low, emission pathways rather than absolutely, green investments. So definitely what determines or which activities can be the transition activities and how those transition activities are classified, monitored and financed is something what we are also looking for in the green finance taxonomy. So without the green taxonomy, definitely that creates a lot of challenges for the stakeholders. We definitely know that most of the developments like RBI has come up with new notifications. Not, I wouldn't say notifications, but there has been talks about integration of climate risk assessments. So all that is, of course, there. But unless and until there is something which is, notified, which comes as a thing which is accepted across all stakeholders, definitely there is a challenge over there. Now coming to the supply side constraints, of course, as we all know that there is a risk return mismanagement or it is risk return misalignment between the risk takers and the finance givers. So of course there is a mismatch between the expectations of the financiers and the kind of climate investments. Without de-risking, without having someone taking the risk, green projects, definitely the smaller or the newer emerging technologies, they suffer in this space. Utility scale renewables, definitely, they have scaled faster because because the markets have evolved and the projects have become bankable. We have there is a huge volume of institutional capital, which is the capital which is available with the insurers. That capital is there, but definitely the LIC, they are also not allowed to invest in the lower rated projects, which are A minus or B plus. And I think Sheetal is here and she will deliberate upon this. So the space of green assets in institutional capital, that has also been very limited, but definitely it has a very high potentiality. The other insight which we get in terms of a challenge is definitely the international capital. We all know that it has in terms of exchange rate fluctuations, if there is volatility, though the initial momentum of the green finance investments were through the foreign pension funds, the sovereign wealth funds, but institutional investors or infrastructure investors still, face this as a challenge. We definitely also have very limited exit options like the InvITs, which are there for investors. Very recently, there have been certain changes in the rules and regulations for which they are able to invest in the InvITs, like through private placements, but definitely that's also a very limited option. Lack of platform level equity, we definitely understand that this is one of the major challenges, and the reason for this is basically most of the projects in the newer spaces, they are all smaller fragmented projects. So what can be done to kind of provide a platform level equity and aggregation of these projects, which can actually enhance their bankability. So with all these, we have tried to develop a climate finance architecture framework. So I wouldn't go into the details of this specific framework because it is kind of lays out the various steps, I would say. The main is the pipeline creation and demand origination, availability of equity capital, availability of debt capital, where intermediation can take place, and ultimately where institutional market finance can enter. So in all these spaces are very much interconnected. There are specific risks and specific challenges across all these spaces. But there are certain institutions, or which we call as financial intermediaries, which can actually have a lot of role to play in this, and to facilitate, in terms of the challenge, they can facilitate the transition. We will be sharing the report and the link to this particular report and the specific details of this framework, and what role the lead institutions, which are mentioned at the bottom, they can play. Some of that has been outlined, and definitely in the course of the discussion, we will also try to kind of deliberate upon some of those points and some of the potential role which can be played by these intermediaries. So in terms of overall recommendations, I will just take a minute. And so we definitely believe that it is not, we can't look at the climate finance from a very disaggregated point of view, but we have to look at it from a systems perspective. And here, that is what the entire value chain, rather than looking at it from a very discrete point of view as discrete assets, we need to look at it on entirety. And definitely the effectiveness of climate finance will depend upon the strength of the entire institutional system. These specific recommendations which are there, this is specifically based on the climate finance framework which we have, and most of the roles for this, like in terms of unlocking scale in the fragmented sectors, they require demand aggregation through platform-based financing models, and there SIDBI and NABARD can play a very prominent role. There can be contractual and market frameworks. Again, escrow-backed payment mechanisms, absolutely. In infrastructure financing, we know how important the escrow-backed financing or payment mechanisms can be. Expanding the green bond markets is very specifically. It has a huge potential. Developing pooled securitization frameworks and structures like InvITs are the need of the hour. And all these, taken together, will possibly facilitate the movement towards generating more capital into the space or unlocking more capital into the space. So with that, I will conclude my presentation. The details will be shared in details over the chat. Without any more, we will move now directly into the major discussion of the major panel discussion. And I will quickly take a minute to introduce our, esteemed panelists here. So Mr. Upendra Bhatt, he's here. He's the co-founder and managing director of cKinetics, which is a leading sustainability advisory firm specializing in climate finance and energy transition, resource efficiency, and sustainable investments, with over 25 years of, maybe more than that, of experience spanning industry and consulting. He has advised governments, multilateral institutions, investors, and businesses on innovative financing models, market development, and sustainability across Asia and other emerging markets. And he has played a pioneering role in advancing decentralized renewable energy, ESG, and climate finance initiatives. We have Labanya, who has over 20 years of experience in financial services, green finance, and international development. He's the director at the Center at the Climate and Sustainability Initiative. Additionally, he also serves as a visiting senior fellow at the London School of Economics and Political Science. He has previously worked with organizations like CW, the Climate Policy Initiative, UNDP, WRI, and ADB. We have Sheetal Sharad, who is the Chief Ratings Officer of ICRA ESG Ratings. She has been associated with the group since 2008 and over the years has been involved in executing rating assignments and carry out research activities across various sectors. She was also a member of the rating committee of ICRA for corporate ratings and IPO monitoring. Prior to joining ICRA, Sheetal was a corporate banker at ICICI Bank. She has earned an MBA from IIT Madras. She holds a Bachelor of Engineering in Electronics and Telecommunication from Rajiv Gandhi Technical University, and she is also currently pursuing her PhD. We also have Deepak Kumar. He is the head of ESG cell at the Union Bank of India with over more than 17 years of experience in financial risk and management, sustainable finance and banking regulation. He has played a key role in integrating climate risk into banking practices with expertise spanning ESG, credit risk, climate stress, stress testing, financed emissions. And he's also a certified financial risk manager and sustainability and climate risk professional. And he has been very active contributor to policy and industry discussions on climate risk, transition finance, and sustainable banking. We also have our moderator, moderator is Shantanu Srivastava. He leads the Sustainable Finance and Climate Risk Initiatives at IEEFA South Asia. His core focus is to support the development of a robust sustainable finance ecosystem in South Asia. He also works closely with financial regulators and intermediaries, offering strategic guidance on managing climate-related risk and harnessing opportunities emerging from energy transition. With this, I am going to invite all my panelists and over to Shantanu for initiating the panel discussions. Shantanu, over to you.
Thank you so much, Riya. First of all, thank you so much for inviting me for this very important discussion. And congratulations on a strong report and a great set of recommendations to improve the flow of mobilize the capital for financing India's energy transition. I think you and Dr. Palit have already set a very comprehensive, context for our discussion today. So I'll just jump directly into the discussion. Just some housekeeping rules before we start. I think we have roughly around 45 to 50 minutes or so, and then we'll have probably some time for Q&A and in the closing remarks. So we'll try to wrap it up, wrap the discussion within 2 rounds. We're going to have a round-robin discussion, and we'll have 2 rounds, and then we'll have some questions from the audience as time permits. So I think we have Upendra also, who's joined us as one of the panelists. So Upendra, maybe we can start with you. If you can hear me.
Yes, I can.
Great. So, let's start with, one of the things that both Dr. Palit and Riya have talked about, that how grid scale renewables have actually been, one of the success stories for India's energy transition financing. And we know, while that is one of the asset classes that obviously needs much more financing, there is the energy transition story is much wider, right? We need upwards of $250 billion to be mobilized on a yearly basis into just mitigation to finance India's energy transition. Uh, my question to you is, what really has worked in the sector for grid scale renewables is the fact that there was a lot of policy related tailwinds, specifically standardization through SECI intermediation, payment security mechanisms, plug and play through, solar parks, must run status. There have been several policy tailwinds. Now, when we look at the next set of large scale infra assets, be it green hydrogen, electric mobility infrastructure, uh, battery storage, what do you think we can borrow from what's worked for grid scale renewables? And where do you think we need completely new set of policy measures to mobilize the same kind of capital that we've been able to do that in the grid scale renewables?
No, thank you, Shantanu, for that question. But before that, thank you, Ria and Debajit, for putting this conversation together and for having me over. To your question, Shantanu, I think you touched upon some of the building blocks that have made large-scale renewables workable, right? And the bankable pipeline, as you correctly identified, emanated from, I think, starting from the sectoral targets, right? Which kind of gave a sense of market making and broad market signals, and then bundling, etc. So if I really look at it, on your question, I'll break it into three components or two components. One around what building blocks are leverageable, and two, in what sectors would they be most efficient currently? And then, what could be the other areas where policy interventions could work, if that makes sense, right? So I think on the first one, essentially, if you look at it, nobody will deny the components really came from four things, right? One was the approach on the project preparation itself, so that you could standardize them, you could bundle them, you could aggregate them to make it a cogent pool of projects that people could respond to, right? To achieve scale as also help you drive down costs. So I think that is a element that I think will play an extremely important role when you look at green. We're already seeing that slowly in the BESS space. You will see that in green hydrogen. You will see it in, I would say, commercial freight, etc., as well as we go forward. So I think that's one aspect which will be critical. There are others in the building space where it will play a role. The second one, I think, which is important, would really boil down to the role of strong institutions, right? I think while the very first auction went without SECI, I think very early on the government realized the role that you would need to have. And I think that I think will be another theme which I think will become important. A surrogate mechanism of that really is being played out, if you see, by the asset initiative of the Niti Aayog as we speak today, where they're trying to kind of bring that. But I think you'll have to move it from an enablement to an active, intermediary role of some sort to take other sectors, particularly the ones which have a role with the local municipal bodies, transportation fleets. I think there is also a role for a new age, super efficient ESCO kind of program pipeline in certain sectors. We have been hearing about super efficient appliances. I think there is a role around motors. So I think those are some of the areas where this would be extremely critical. The same building blocks that you saw would need to be leveraged, but leveraged with the conjunction of these things coming together, right? You could obviously create incentives to allow for green or concessional finance to respond to this, right? There is, I think, enough capital. Most bankers will tell you that if there is a good bankable pipeline, money is like water, like a river. It will meander its way and get to the right level sooner or later, right? So it's I think the building blocks which are important. Which brings me to the point around your policy interventions, that what will take it. So firstly, I mean, these numbers, 250 billion, Niti Aayog number looks at it slightly differently, etc. And there is I think, a cascading effect based on how you're looking at market making and local manufacturing value chains and price discovery. So I think there'll be some efficiencies which will get discovered further on these needs. But irrespective, I think what you would need is one, harmonization of both ambition and articulation in the financial regulations themselves. So if you look at it today, you have climate now as a component wedded into based on what RBI came with. It will, my sense, get intensified in next 3 to 5 years further as a Basel globally kind of steers it that way. But you don't see that similar being mimicked by the other three regulators. I think there is an interest brewing, but we don't have that consistency. And that obviously then presents a conflicting signal both to the domestic institutions, but certainly to the global capital that we all are claiming is needed in some level, even though the bulk of the work. The second one, I think, is, and this is not just me speaking, I think there has been ongoing things Niti Aayog report talks about, and other reports we ourselves that we have published have talked about it, is the role of the specialist green financing institutions, because or an EPICS financing and refinancing structure. Because I think these technologies will continue to evolve. There will be a role and opportunity to look at risk elements that you are not locking yourself in, right? Some of these technologies are competing. It's not that the government is saying that this is the only technology options roadmap, right? So how do you allow for the role of the markets while, so I think the specialist financial institutions which will have the ability to look into it, backed by an apex institution, would be key to looking at and leveraging that, right? A good example is that you did have initially a credit guarantee which ADB had bankrolled, and then IFC came in initially, etc., which gave comfort to the large equity guys to come in and set up platforms, etc. So I think you would need that bundling and balancing, as also to address asset liability, which happens at a sub project level or an asset level, whatever the end state of that capital or form is. I think the other big piece here would be about the role that policy would need to play and regulation in enhancing the corporate bond market. I think in India, historically, banking finance and bond markets have overlapped and competed, but I don't think you can allow that to continue. You will have to at least double the bond market, and also as newer and newer entities evolve in the green space, I think that's would be an instrument of choice. You obviously have some windows around transition bonds that IFSCA framework is providing. There are some sustainable linked loans, but I think policy prioritization and risk weight outlooks on some of this will be critical. The last one is there is a lot of global capital that would love to come to India. But when we end up seeing that the cost of capital is still high, partly driven by historical sovereign ratings, etc. So could there be a role and opportunity for foreign exchange hedging? Or on the other hand, you could take a more bold step in full capital account convertibility. So some of those elements I think will become key to taking this forward if you really are serious about it. I mean, each of these sectors would have a role to play in tapping into the demand side of it. So if you look at green hydrogen as an example, you already are seeing procurement mechanism backed by financial and fiscal incentives. But I think a lot of that will be, I think, evolved under the Article 6 deals, in my view. So I think to mirror that in the Indian context, you would need to create demand side hydrogen purchase dimensions, right? So I think those are the things. So there'll be a lot of micro to this, but that micro cannot be devolved from the macro of putting this all together. And I could pepper with other examples with asset, right? They're doing municipal water pumping, they're looking at some, all of those, I think, lend themselves to this.
Thanks, Peter. I think you've really touched upon the overall gamut of what is really required, to not just from learnings out of the grid scale model that is worked, but also the new interventions from the policy and the market side that is required, to really mobilize capital into the other so-called sunrise sectors. Uh, and I think, like you rightly mentioned, RBI probably is the front runner when it comes to the regulatory space, right? Including the draft regulations on TCFD aligned disclosures and the recent one around ECN and SICR related, regulations for banking industry. And at this point, I would like to bring in Deepak. I think he has been a very vocal on several platforms about the implications of these regulations on the banking sector and how they would probably help bring in pricing climate risk in banking institutions. Deepak, if you can hear me, this next question is for you, and probably also taking from where Upendra left. The biggest benefit, I would say, of standardization through policy has actually been for the banks, where they've actually over time got the comfort to provide long-term, not long-term, but big ticket capital to renewables. And that's why we've seen, domestic banking institutions have played a very important role. And now the NBFCs, the PFC, RAC, REDA of the world, playing a very important role in scaling up renewables in the country. Now, while that standardization in terms of big ticket, you know, sizes, predictable cash flows, credible counterparties. That's a feature that we have for renewables. The other sunrise sectors, right? They don't really have those kind of characteristics, but we still need financing for them. So purely from a banking sector perspective, how do you think, what would generally change a credit committee's appetite for, these new kind of assets, right? From storage to EV fleets, to something like green hydrogen, which don't always carry these kind of characteristics. Over to you, Deepak.
So first of all, thank you, Riya, for the beautiful report and bringing me here as part of this discussion. And thanks, Shantanu, for this question. So now, from the banking sector perspective, so whenever we look at financing any of the assets, so whether it is the climate-based assets or any other asset for that matter, so we mostly four things. So the first thing is that how is that counterparty? So what is the credit worthiness of that counterparty? And that is common to all. So whether it is climate related or any other asset which we are looking at. So that's common, and we will not go into detail of that. Then there are three other factors which we look at and which are very important from climate point of view. So we look at that. What is the predictability of the cash flow? So the asset which we are financing, so is that adding anything to the revenue, or it is saving anything from the cost point of view? So and what is the predictability of that? So that's the number one thing which we are looking at. Then once we are sorted on the cash flow predictability assessment. So then we also have to look at that, what our policy says. Is there any precedent in that? What kind of documentation we have got for that? Do we have any product for that? And in case if we have got multiple requests for that kind of asset, so we develop a specific product for that. So we standardize that process. Okay. So the second is the policy or the product which we have got for that kind of asset. Then the third thing, which is very important and which is very critical in the climate related whatever financing which we are doing, is on the collateral realizability part. So when we price anything, so we have got three important factors. So PD, PAD and LGD, probability of default, exposure at default, and loss given default. Now in PD is in this case is the credit worthiness of that counterparty. So what is the probability of default of that? And it is irrespective of that asset which we are financing. Exposure is the loan amount which we are looking at. And LGD is something which is very important when it comes to pricing. when we, for example, we compute risk-adjusted return on capital, and for the pricing when we compute expected loss, or now with the coming up of expected credit loss. So in that, LGD is a very important factor. And with LGD, so the loss given default, the realizability of the asset in case of default is very important. So you talked about three sectors here. So one is on storage. So on the storage part, the problem is on the cash flow predictability part. That whether how so how sure I am about the cash flows, and over what tenor of period that those cash flows are predictable. Then in terms of the other product which you talked about, like EV fleet. So in EV fleet, the biggest problem is the realizability of the collateral. So in that, we have got two unknowns here. The first unknown which is there uh, is that the battery which is getting used in those EVs, so that forms the biggest chunk of that, and it's not like an existing internal combustion engine vehicle. So we should have a separate appraisal mechanism for that, and then the realization value. That what will the realization value if a customer defaults? So there has been talks of marginal assistant facility, or wherein LGD can be capped. So we need to solve these problems to arrive at a constant LGD for that, and then only we will be having a proper expected loss for any product, and then we can have a proper risk-based pricing for any climate-related lending which we are going to do. In terms of providing financing for example, MSMEs for renewable energy. So there the problem is that each MSME has got their own different credit worthiness, and they have got their own problems with which they are struggling. So we do not have a specific template which can be applied for all MSMEs. So for each MSME, they are at different levels of their stress, and each one has to be looked at differently, and they are all operating in different environments. So someone has got leased premises, someone has got their own premises, someone has got roof rights, someone has not got roof rights. Then in terms of someone is having term loan but no working capital, but someone is only having working capital, no term loan. So how we can fit financing for rooftop in MSME is something which requires externalization.
Okay, great. So what I hear is it's still the same conventional issues that banks always face. It's the collateral, it's the cash flows, and it's, I think, also the relationships that you have end of the day with the borrower, that really matter. And what I understand then is, for a bank to really, actually gain confidence on these new set of low carbon infrastructure asset, there is going to be a natural process, which was followed with renewables. It's going to take time for, the bank to also gain confidence, build products, processes, and standards for these new ones also, right? I know, Deepak, that you have to leave at 4 o'clock, so maybe I can bring you in for another question, which was parked for the second round. Sort of complements to what you just mentioned. Another big issue that we've seen, and this is a classic issue that banks have when you talk about financing large-scale infrastructure, is the classic asset liability mismatch, right? And it's very much an issue for emerging markets like India, which where the banks have, the deposits which finance a lot of their, loans. Now, while we know that a lot of financing for renewables has happened from banks in India, they're not the most ideal, intermediaries to do so, right? It should be through the capital markets ideally. However, if we were to follow the same pattern, and we've seen that the likes of PFC, REC, even SBI have raised something like an infrastructure bond to match liabilities with the asset life. What do you think are good measures on this front to firstly counter the ALM issue that banks have? Secondly, and I think that this is also an issue, to overcome the exposure limits that banks face when they're let's say financing assets in a particular sector, and RE, as we know, is clubbed in the wider power sector, right? So how do we navigate these two? Do we need more refinancing, deeper refinancing? Do we need more, consortium financing? What exactly do you think would help banks to navigate these issues as we move forward to new set of assets?
So in my view, again, this is my personal view. So this is not an asset liability mismatch kind of thing, which we generally try to put it in terms of tenor. So, for example, in banks, we as a part of asset liability management, we do behavioral studies. And what we generally try to do is that we take deposit and then try to see that what is the tenor of asset, what is the tenor of deposit, and then try to manage the risk. But in terms of deposits, when we comes to CASA, so current account and saving account, so they are the stickiest deposit, and banks have as per their behavioral studies, so they are in the highest tenor buckets they are placed. Okay. So in that we have got 4% and volatile portion. So the 4% is on the highest tenor. So it's not a liquidity problem, but it's more an interest rate risk problem, wherein we have to manage the interest rate risk. And now, as per the recent RBI interest rate risk in banking book guidelines, so there is a concept of economic value of equity, wherein we have to see that what is the impact on uh, uh, of repricing of plus minus 200 basis point on any asset. And if that asset is a long-term asset, then the impact would be very high. Okay. So that's the new risk which we have to look at. So from the solution point of view, what I think is that so takeout finance is one of the biggest solution which I can think of in this case. Then there are other solutions which has been given. So, for example, we talk about first loss guarantee and all. But when it comes to climate-related finance, so first loss guarantee will not be sufficient if it is not leading to any reduction in RWA. And the first loss guarantee, which the entity which is giving that guarantee, so then that entity should be recognized as per the RWA norms that reduces the overall risk-weighted asset which is applied to that customer. Now, again, so apart from this, what I can think of is in terms of securitization, there is some solution to this. But for securitization, we need to create a specific pool of homogeneous assets which can be securitized. So, and that will be freeing up the capital, which can be leading to the recycling of the capital. And then again, there is a large talk on the partial credit guarantee for tenor extension. So, which also I see one of the solutions which can be introduced here. But again, so that is at very nascent stage. So to conclude, securitization is something which we can think of, partial credit guarantee, then reduction in RWA, and also looking at this from the interest rate risk point of view rather than a liquidity point of view. Thank you.
Great. I think that's good to know, because that this is a term that is thrown very often, right? The ALM issue. So it's good to know it's not really, not always an ALM issue. It's more an interest rate issue. When you're talking about long-term infrastructure assets. And maybe I can come back to you later on with another follow-up question to that, in terms of what do you mean when you talk about deposit that is not at risk, that is not volatile. Like, how long can you long-term financing can you provide, right? But maybe if you're available, we can come back again. But now maybe I can go to Sheetal. Sheetal, you've you heard during the introduction, you've been as part of a large domestic credit rating agency, and you've seen different credit cycles happen. And obviously, when you talk about any bank-related debt, any infrastructure debt for that matter, credit rating plays a very important, integral role in pricing debt, and ultimately the cost of capital that the infrastructure asset ultimately is assigned. One of the things that we keep hearing in the context of climate over here is that climate risk is probably not being priced in, or not being considered as part of the credit rating mechanisms or procedures of rating agencies, both in India and in developed markets also. and that is why climate risk is not being priced in. Especially for sectors and assets which are fossil fuel exposed. How true is this statement? How well is climate risk, both physical and transition, being considered as part of the rating mechanisms of CRA? And what basically prevents this pricing into actually happen of climate risk by CRAs? And another flip side of this question is that this is more so for fossil fuel exposed sectors. But what about the new bunch of sunrise sectors, like the low carbon sectors, where there is very thin history of operations? There isn't a lot of credit history that you can base your assumptions and ratings on. What do you do in such kind of assets? And we've seen that in India, renewable energy assets, grids here are also not have very rarely been able to do AAA plus or the grade that other power sector assets, conventional power sector assets have got. So what is the reason for that? And I think this is a problem more for the new set of assets, green hydrogen and others. What is the issue when you talk about sunlight sectors, and what is the data gap, or what would really help credit rating agencies to actually bridge that gap when you talk about these other set of assets? So these two questions, if you can talk about.
Thanks, Shantanu, and thanks, CRF, for having me. Pricing of climate risk, whether it is getting included or not in credit rating, it's not that credit rating agencies will look at specific risks and not look at some other risks. If it is a risk, obviously that will be included in an assessment for creditworthiness. Now, the issue is it will get priced as long as it is felt that it is material and is changing something in the default statistics or in the probability of default. So as long as it is, we feel that it is connected to default risk, you will see it get priced. Now, what is the issue there? The issue there is over the rating horizon, over the horizon of the instrument. If that is something which is considered that as a risk, it will definitely impact cash flows and it will get priced in the credit rating. So if you talk of physical risks, as you said, we may not call it climate risks because that jargon has come only in the last few years. But we may talk of, say, asset concentration, geographic concentration, or specific such risks for any project or entity which we are rating. So the physical risk, it gets addressed actually to that extent. But the issue is that climate change risk may, play out in a much longer fashion. And there it becomes difficult to forecast it. Because it is difficult to forecast, difficult to quantify, therefore the creditworthiness gets impacted. You will get that included in the credit ratings as well. And the entire loop of what we've been discussing till now, that, predictability of cash flows, what are the supports, things like that. Now, if you see what are the dynamics there, so you spoke of fossil fuel export sectors and, what is happening there. You look at what is happening. For example, the carbon credit trading system, the CCTS, which has come up. So that is one mechanism, while it's starting this year, but that is one mechanism which is eventually going to give us a variable in terms of quantifiable variable. So you have a carbon cost. So once we have that, you will see that trickling into the cash flows and then again getting, influencing the credit ratings. So as and when this becomes more organic and more visible in terms of clarity, you will see that coming as part of credit rating, because there will not be any special status which a lender or a credit rating agency will give to a specific project. Now, which brings me to what you said about, emerging sectors or sunrise sectors. So same rules apply actually. Anything which does not have track record or history, there will be more questions there. If we do not have reliability metrics on technology, if we are not very sure how this is going to play about. So imagine how it would have been at the start of the entire RE adoption phase. So then rating agencies and, as Deepak was saying, lenders start looking for other support mechanisms to see whether there is any other support for the payment capability of the entity. Now, that can come through guarantees, support. One important point I feel is that maybe the strategic importance of such a project, which will again lead to the parent or the promoter or some key investor really supporting it can support the creditworthiness from a financial flexibility viewpoint or a cash flow viewpoint, also from a liquidity viewpoint. But if that is not there, then you will see the constraint in the cash flows and in the credit rating. Now you asked that what will help. Now, one is, as more and more demonstration comes in, there is more comfort across all stakeholders. Strategic importance is something else, but there has to be some formalization, like, Dr. Ria spoke of green taxonomy or, such projects not getting capital. So you look at one thing. I really liked what Upendra said. One cannot expect the traditional bankers to keep supporting or to try to support such projects at a lower interest rate because they have their own RAROC metrics to follow. So obviously, it is a high risk, high return kind of a situation. So to those kind of finances, or you will have that kind of a bridge financing or a initial stage financing, which is at a high interest rate. To that, things like one is what Upendra said on deepening the market in terms of the fixed income or the corporate bond market. There, if you have formalization of climate-related instruments, while we've been talking of transition bonds or sustainable is much lower than what you would expect. One of the reasons there is because there is no arbitrage. So if that market deepens and there the covenants are linked to climate, the covenants are linked to such structures which give comfort to the investors, then that can get translated into ratings. Now, when we say ratings, not just credit ratings, you look at SEBI. Now SEBI has come out with something like a transition rating. So it shows that how well is this entity going to transition. If something like that can be linked to a sustainability linked instrument, that will give more comfort. And then you have a pool of similar assets, and then you can, take the next step and go to securitization. So having that kind of an additionality in terms of those kind of instruments, while SEBI has, kind of come up with some guidelines and circulars on, listed ESG instruments, for example, but the offtake has to be there. So once you have that, there will be some kind of a track record in place, and you will see capital coming in, more comfort, and then that the entire cycle starts. Then you have your pooled assets, which can be the next step. So that is where we feel. So the credit rating will also move along with all of this. I mean, one can also argue that why not have something separately on climate, like what RBI is doing. RBI is trying to look at how to quantify this, how to tell banks that, what is green, how green you are in terms of portfolio, or how brown you can go. So there, if you have quantification, you may see emission reduction targets or CCTS getting, integrated there. We don't know as of now, but that also could happen. So these are the, actors which earlier was being talked of, which can help. And then, there can be a separate maybe a climate rating kind of thing, or you want to integrate that as part of credit rating is something which is a policy decision.
Okay, great. No, I think that's good to know. And I think we understand physical risk probably is getting priced in, right? Because that is something which there is some precedence also. You understand, how that could impact. What is the value at risk over there? But broadly, I think what I understand is that there isn't enough information to actually price in climate risk from a transition side. Even when the CCTS hits the market, right, you have the price discovery that is happening. You would probably need some years of or some, historical precedents to actually price in that kind of data or bake that into credit ratings. And that might also not be, I don't know whether that would eventually give a complete picture of the climate risk in a particular asset or a particular sector. So I think those are some of the questions which we probably have to answer when we start, incorporating either data points from something like a transition bond, or let's say, from BRSR or something like, transition plans from corporates, and how that actually helps us in discovering, climate risk. I think that the other question, when you talked about that, right, and Upendra also talked about that, we do need deeper capital markets, right? And we've been talking about that for a very long time. And one of the things, while there is obviously a lack of liquidity, right? The institutional capital that is present in India from the pensions and the insurers of the world, uh, that is very, very comfortable in terms of providing money specifically for the government securities, the state development loans, and the top tier PSU debt. And what happens because of that? And we've seen that in developed markets like you know uh, Danish pension funds, for instance, they've provided a lot of project level equity and debt to scale up renewables, grid scale renewables in that particular jurisdiction. We have a lot of presidents from other jurisdictions also. But when we talk about India, while we have a lot of institutional capital that is global, that has provided primary equity, that has come into recycling also of assets, but our own domestic institution investors have largely been sitting on the fences, right? So Lavanya, my question to you is, and we've talked about that a lot, we really need this large domestic pool of capital to contribute towards, India's energy transition financing. Uh, and we've seen that it's not really happening. So what do we need? Do we need regulatory changes? Do we need new market mechanisms? Or there is something completely different, right? We've tried InvITs, they've not worked. We've tried several other things that have not worked, right? What do we need to mobilize this large chunk of capital into financing India's energy transition, in newer set of assets?
Yeah, then thanks, Shantanu, for the question, and thanks, CRF, for inviting me to this event. Okay, actually, I don't have a clear answer what we can do. It's not so easy to mobilize so much of capital. We keep on talking about the institutional capital. Unfortunately, if I compare the institutional capital, primarily pension fund and insurance company in India, and we always compare with institutional investors abroad. So there is, you will see that institutional investors mostly they're exposed to corporate fixed income securities. But unfortunately, here in India, the exposure of institutional investors to corporate fixed income securities is very, very less. Okay, usually they should be risk averse investors, but you will see on the other side, they are more exposed to corporate equities compared to corporate fixed income securities. I believe that one of the primary reasons is that since they are heavily exposed to government securities, okay, and at the same time, they want the investors because they are not primarily insurance companies. Okay, many of them are basically insurance plus investment companies. They need to show that okay, we are better performers than the bank return. So one of the reasons why retail investors they moved away from commercial banks by depositing their money in commercial banks, invested in pension fund or particular insurance company is to secure higher return. So that's one of the reasons. So we need to change that behavior that, okay, they need to increase their exposure to fixed income securities. The second point is that, is there enough quality of fixed income securities? It's a big question mark. Like UB said, and also other people said that whether we have enough good quality of fixed income securities. The answer is no. We don't have enough good quality of fixed income securities. And most of the good quality of fixed income securities are issued by financial companies. Okay, so if we see the corporate bond market, so 75% of corporate bond fixed income securities are issued by financial companies. The rest 25% are issued by non-financial corporation. Okay, and most of them are not very, very attractive. And if you speak to all of them, they will say that, okay, what is the kind of return I'm going to generate? Okay, I'll get it to 8.5%, between 7.5% to 9%. Okay, if I put my money in equities, it will be 13-14% without not taking a very, very high risk. Okay, it's a question mark for them. And if I put my money in government securities, I'll get it maybe 6.5% or 6% or so. So the delta between corporate fixed income securities and the government securities is not very high. So it is not very, very attractive for institutional investors. Then I'll come down to quality of fixed income securities, whether there are enough AA or AAA fixed income securities by a non-financial corporation, it is absent. Okay, then the question is the credit enhancement instrument we keep on talking about. Okay, that should be an institution who should provide credit enhancement so that these fixed income instruments can improve from BBB or single A to AA or AAA. But if you talk to institutional investors, they will say that, okay, I'm not convinced with these credit enhancement instruments because there is not enough transparency Okay, if there is not enough transparency, nobody is going to buy. And there is also conditionality attached to this credit enhancement instruments. Okay, so we must, if we really want to make it successful, it must not be conditional for institutional investors, because as an investors, you are taking a bet that, okay, somebody will come to rescue me, okay, particularly at a time when there is a default. But there is some conditionality as an investors you may not be able to understand, because it is an agreement between a company as well as and the credit enhancements company also. So it is very extremely difficult actually. The kind of risk these investors are exposed to, they are not willing to take. Okay, so we need to see that whether it is conditionality and whether it is irrevocable. Okay, these two conditions must be there to make it attractive. The second point is that whether the companies really want to issue fixed income securities, okay, bonds, or they're happy with to raise capital from commercial banks or NBFC for 5 to 7 years. But if they're raising capital from NBFC, it can be 12 to 15 years. Are they willing to do? Okay, that's another question that, okay, as a borrower, if I'm not getting a lower interest rate by issuing corporate bond, what is the benefit I'm deriving? The only benefit could be, okay, there will be no refinancing risk, and I possibly issue bonds for a longer period of time. But unfortunately, there are not enough long duration bonds here in India. Okay, in the renewable energy space, except one company, I don't see that there are any companies whose corporate bond duration is more than 10 years. So there is no benefit for the borrowers. It means that we need to maybe push, pull, whatever, okay, nudge borrowers to move to the capital market, okay, by improving the credit qualities of the bonds issued by them. Then third is that can you provide some kind of interest benefits or some tax incentives based on the interest income provided by them? Historically, it has been done in the infrastructure sector. Can we do it again? Maybe for a few years, if we think that renewable energy addition is important and we need to attract capital from institutional investors, okay, let's give some tax benefits on the interest income for a couple of years. Is that a possibility? Then there is an additional incentive for institutional investors to invest. Okay, that's a possibility. Then another point I would like to highlight is that if you see the global pension funds, particularly Canada-based and some of the Scandinavian investors, they invest in companies, both in equities and bonds directly. Okay, it's called direct financing route. But theoretically, this kind of investors, they invest in liquid investment, liquid securities. Those securities must be traded in the stock market or bond market, because one of the reasons is that there is high liquidity available. They can exit from their position very, very quickly. As I said earlier, they are risk averse. But that is changing very, very quickly in the global market. But unfortunately, it's not changing in India. Most of the people in the institutional investor space, they don't have capacity to conduct due diligence, which is required for a direct investment, be it alternative investment through alternative investment funds or private equities, or even project financing or project bond or so. Okay, so they need to add capacity or bring people who have a better understanding of project financing, better understanding how through the AIF they can invest in renewable energy sector. Then the fourth thing is that, okay, it will take a longer time. They need to add capacity. There is no regulatory barrier here. For example, pension fund and insurance companies, if I remember correctly, up to 5% of their assets, they can invest in alternative assets. So when I'm saying alternative assets, it's securitization, InvIT or IDF or all kind of instruments, okay, beyond bonds and equities. But if I see their exposure, it's less than 1%. It means that legally they can invest, but in reality, they are not investing. Based on my conversation of some of the private equity investors, they are saying they are going to the pension fund regulator and asking them, okay, why don't this pension funds put some capital through us? Okay, at least there will be some learning by the pension funds, okay, how to invest directly till they build capacities. We also need to remember that the return on the alternative invested assets is higher than the return on any listed instruments. So there is a possibility of higher return. I also understand that these investors are prudential in nature. They need to take care that, okay, how to manage my portfolio, how I can balance my bonds, equities, and alternative assets without really worrying my pension holders when they're going to withdraw pensions maybe after 10 years, 20 years, depending on the duration. Then the fourth thing is that can you create additional carve out in the insurance company? For example, insurance company, they need to invest close to 18% of their capital in the social sector plus infrastructure sector. Okay, can we create a small portion, maybe 2 to 3% to start with? So it means that at least the institutional investors can learn something about renewable energy sector or the energy transition sector. Once they learn, there is a possibility they have a better hold of the sector, better understanding how the economics of the sector is developing or evolving in the future, so that they can invest more capital. So that's another possibility also there. Okay, I'll stop here and wait for other people's insights. Thank you.
Thank you so much. I think there's a lot of really good points and recommendations that you've provided. I also see this as a chicken and egg problem. We talk about, the long duration, uh, bonds not being there in the market from the corporates. But we also don't have that appetite within the market to actually, give that confidence to a corporate to come out with such issuance. And I think the ratings issue is a classic one. That's what I was talking to. I mentioned when I was posing the question to Sheetal. So Sheetal, maybe I can come back to you again. So while we don't have deep capital markets for corporate debt, uh, financial sector, I mean, NBFCs have actually been really successful in raising capital from the markets. In fact, banks have been the largest holders of NBFC debt. RBI had to come in and stop, put a hold to that due to overexposure concerns. And we've seen NBFCs in India, like the PFC, REC rate of the world, they've been able to raise capital from global markets also, and then on lend, to the developers within the country. So that is probably a good route. At least one of the routes through which financing for renewables and other low carbon infrastructure could happen in India. Now, when we talk about mobilizing capital from this ESG pools, global ESG pools, what exactly do you think would give confidence to them in terms of this transition ratings of NBFCs? And I know ICRA also does a lot of this transition rating for NBFCs. What role these transition ratings would play in giving confidence to global capital pools, ESG capital pools, to then provide or invest into issuances of domestic NBFCs, which then can obviously be on lend to borrowers back here in India.
Yeah, actually, NBFCs are quite well placed in the sense that you look at how they are growing and the kind of various different end uses they can cater to. One is social, which they are already doing, but definitely there too, there is a lot of requirement, and you can see money chasing all the SDGs on the social side, because that's the entire financial inclusion angle, and that also links it to green. And because they have this ability to reach at the grassroots level, I mean, you took some bigger names, but there are so many other, medium-sized and smaller-sized NBFCs also who are looking at diversifying their portfolio basis end use, and rooftop solar, EV, green buildings, energy efficient solutions, sustainable agriculture. They do have a lot of appetite. They're starting small, but they have, as the understanding develops on what these products are, they want to diversify their portfolio as well. Nobody just wants to be just on MFI or some specific, loans. So that is where they are kind of having a multiplier effect in terms of creating that impact. Now, on the other hand, as we've been talking, global capital is there and they want to get participation in such end uses. And you will see a lot of mitigation purposes also, not just adaptation, even mitigation. So both purposes. While these bigger names, which you said, they do have much better fundraising capabilities. The smaller NBFCs, what we are seeing is, while the ones which have a good track record and have better understanding, they also have started looking at diversifying their funding mix and getting these DFIs and ESG sensitive investors, not just impact investors. There's a big pool of different kind of investors because different investors may have different motivations to get into this. Maybe an investor has a brown portfolio and wants to add green, or they're just in line with specific SDGs, etc. So for then what we are seeing, and very interestingly, we see a lot of interest for impact ratings, which we do. Transition is something wherein we are looking at how companies are decarbonizing and improving their ESG profile. In impact, we are, just looking and assessing on what is the impact of the NBFC. And typically for most NBFCs of the next rung and below, uh, this becomes a signaling instrument and also a big learning instrument for them, or way channel to show to the market that what they are doing and what impact they can create. And what we bring in there is try to help them to internally also understand where their gaps are, where their strengths are, how they can measure this impact and tell the investors. And then that gives confidence to the investors to come in and see that there are so many players, but who are the credible ones, wherein such kind of an independent opinion helps. Now, and this is not like just looking at a BRSR and scoring based on that. So the model which we follow at ICRA ESG is an issuer pay model. So that gives us a lot of flexibility in going into depth and talking across in the NBFC, looking at their practices, not just lending, but operational as well. So these investors which we are looking at, especially the ones who are coming from outside, they want a certain level of governance in place, control in place, how risk is being managed, that kind of comfort they want. So that is something which we will get into and understand. And while asking these questions, the NBFC or the entity who is also getting into this exercise gets a lot of learning and knows where they have to work on. So while we would start at some number or some rating level, with time, they will also move towards that and improve their whether lending portfolio habits, whether intent, or end uses, or the way they work. So then it's not a circular problem. So then they start improving their performance on the sustainability or the climate or ESG, whatever word we want to use. And on the other hand, the investors also start getting comfortable. So we have seen a lot of additionality happening for an NBFC, while they had traditional lines of funding, but after doing such an assessment, they've been able to get investors maybe from the European side or even the Southeast. So that is one. The other thing is, once you have this in place, there are so NBFCs also lend to other NBFCs, right? So then that spreads through the market. That this is a way where you can tap more funds. I won't say there will be a lot of cost of capital difference, but additionality also is important. So that becomes which is an advantage for this market.
Great. Thank you so much for that. Those points, I think, very relevant. I think we're just running short in time, so I would like to bring in Upendra very quickly. If Upendra could just take 1 or 2 minutes to talk about, the other side of things. We've been talking about grid scale renewables, grid scale infrastructure, but we also have a lot of disaggregated small ticket size assets on the MSME sides, energy efficiency, DRE, rooftop, which are still not being solved in terms of financing, right? And one of the things which the report also mentions is the missing middle in terms of if you want to aggregate these assets to then bring in institution or large scale capital into them, we need aggregation, and then converting them into something where this large scale, big ticket size capital can come. I don't think so. There is something that like this that has happened in India. If we really want to do that, what do we need to do? And how something like an asset aggregation, clean energy sector could happen in a country like India. So if you could just quickly talk about that.
Yeah, no, I think, as you said, the report talks about this briefly, and I think Ria touched upon it. Essentially, what has prevented assets to get aggregated is one, these are very fragmented projects, retail. This transition is about, getting millions of these assets out there. So how do you kind of work with counterparties who have either been non-existent or have weak credit profiles becomes the first stumbling block. The second is with many of these technologies, the sectoral knowledge, the technology itself, performance or competing technology comparisons, and the supplier performance is still evolving. You do not have comfort of resale, reuse markets, etc., which typically act as backstop. The third is the debt markets itself we talked about, and the cost of capital, etc., and how does that work. So these are the typical elements that have prevented scale to emerge or aggregation, as you use the term, to happen in these distributed assets. However, that aggregation is the key to enable unlocking scale. And invariably, market making requires either socializing or internalizing the cost of that market making. And here, essentially, the underpinning for that is the aggregation piece. And if I look at it, one dimension is how do you look at these, a plethora of technologies, etc., or projects mindset initially to a product, which essentially means standardization has to be the key, correct? How do you bring that predictability of performance? So I think that's important. And the same thing then gets acquired into how do you can bundle this, etc., which, when Labanya was talking, or even previously Deepak was talking of securitization, that can only happen when you have that. The second one essentially is about the specialization of knowledge to allow for these entities to build their moats, etc., and create those mechanisms for adoption pathways, which typically is underpinned increasingly in a data-driven world by the data infrastructure you're able to bring. So ability to bring capital into those components becomes the differentiating factor. In my view, there are 4 building blocks that are required, right? One, are the sectors that close to the inflection point on economies of scale? 2, how well are they standardized? 3rd, is there adequate risk diversification available when you are looking at it like a specialist NBFC level, etc.? Because we have seen in certain segments concentration risk come, not because you have had bad underwriting at a large level, but you have been reading on these initial set of developers, initial set of people who run out of equity. Their equity run rates, etc., they don't have balance sheet strength. So that, I'm sure Sheetal would be seeing maybe 10 such deals a month, right? Where you have that situation. And you are seeing that stress come out and build out in some of these segments. So I think that's the other piece which is critical. I think we have been talking or hearing again and again of blended finance, essentially, but I think the stacks, including the NBFC, where we have been a part of, have helped launch. We have kind of allowed for the aggregation risk appetite to evolve on the base of that blended capital stack. So I think those are some of the, I would say, elements, Shantanu, which are an absolute key. I mean, I can go more, but I know you're short of time. So.
Great. Thanks, Upendra. I think that's a great point to end this conversation. My takeaway from what you said last is we have to socialize this cost, right? Somehow, someone has to bear that, right? Who is that going to be? We have to figure that out. With that, I'll pass it on to Ria. Thank you so much, everyone, for your great points. I also wanted to bring in Labanya, but I think we're just out of time. So maybe
we can still, Shantanu, we can continue for 10 more minutes on the panel.
Okay,
and
great.
Yeah, we can still continue with 10 more minutes. And in case attendees have any questions, please put your questions in the chat box.
All right. Okay, so
yeah, so you
Labanya,
can pose your question to Lavanya.
You're back in then in that case. So yeah, I mean, it's in no particular order. I think I was supposed to bring you in earlier, but the report also mentions the need of an apex climate financing institution, not as another lender, but as a system level orchestrator that addresses coordination failures across the financial architecture. So all the different entities that you have, right, from the SIDBI to NABARD to IREDA, and maybe an AFID, right? You coordinate the efforts of all of these entities, right? But not as a lender, but as an orchestrator. Do you think we need such an institution? And if yes, what kind of a role can this institution play, which would not overlap with what the roles and responsibilities of all the other institutions that we have in India already are, but would complement them? So if you could just talk a bit about
that. Yeah, and thanks. I mean, I think many points have already been covered, particularly by UB. So very quickly, I mean, India has created several institutions for development financing needs. But unfortunately, many of the institutions are privately limited company and listed in the stock market. And if they are going to do developmental role, they are not doing their fiduciary duty. Okay, so we need to create new institution to meet these particular needs. when the NITI Aayog came out with the report. And if we think that energy securities or energy transition is a priority for us, and the current institutions are not really providing the kind of capital required and the volume of capital required, definitely a new institutions can play that role. It's not absolutely necessary to create a new institution. Maybe a subsidiary of existing institution, can it play a role? We need to ask this question. Okay, so one critical point is that socializing the cost. We keep on saying that, okay, internalizing the cost, somebody needs to bear that cost. Okay, and almost all the time, only the public actor, like government, will play a critical role. They can only internalize the cost. Okay, maybe play a market maker, like we keep on saying that, okay, for new technologies, okay, till the point the new technology prove that, okay, it is commercially feasible and can attract commercial capital. So you need anchor institution who can play that role. For example, I think IRIDA started in 1990s. Okay, so at the beginning of 1990s, and it was a development finance institution for a long time. Okay, before it entered into the capital market or to the private market to raise capital. Now it is a listed company. Why a similar institutions cannot be for a green company? Okay, green finance institutions also. If we think that energy transition is a strategically important role. Then the second point is that because in the entire green transition or energy transition, there are many other players who are providing similar kind of capital. For example, there is PFC, there is REC, then there is IRIDA. Okay, all of them are providing capital for the energy sector. And definitely we need to make sure that there is no cannibalization. Okay, many of the institutions, they will say that, okay, what is the purpose of this? Okay, they are also just replacing us. That should not be the role the new institution should play. Okay, the question is that, for example, can you bring additional capital beyond the as usual capital? For example, PFC, if you see the liability structure, I think 25 to 27% of their capital is coming from abroad. Okay, by issuing long-term bond. We can keep on questioning whether it's prudent or not. That's separate part. Okay, we can say that, okay, they have been able to raise capital from abroad. Okay, can this new institution can raise more capital? That is also a concessional rate. Okay, if that is possible, definitely that new institution is justified. Second is that there are some institutions are created for a specific purpose. NABARD is created for agriculture, it be for small industries. So if we can create only green, then there will be competitiveness between the green sector and many other sector. If there is a competitiveness, it will be lost in the massive portfolio of various development bank. It means that you need to create institution which needs attention. I have personally analyzed green banks of other countries. One of the reasons they created green bank, they said that this sector needs attention. And since the development finance institutions have created for a certain purpose, the kind of attention it needs, it will not get the attention if we are going to in-house that in an existing institution. Till we create maybe a subsidiary of an existing institution. Third is that can it create a financial innovation? Okay, India has a history of creating institutions which provide debt capital all the time. Okay, now the question is that the commercial debt capital, even if not commercial debt capital, is debt capital enough some of the climate tech technologies? The answer is no. If we said about that, at some point of time, equity capital will be over. Okay, for some of the technology company which wants to migrate from TLR, let's say 5 to TLR 8, okay, you need equity capital. Can this new institution provide equity capital? Can this new institution provide credit enhancement? We keep on talking about credit enhancement all the time. I can see that NAFID is doing a phenomenal role for credit enhancement. Can this institution can provide credit enhancement only for, let's say, renewable energy sector for the time being? Okay, can this institution create, let's say, financial innovation? For example, we keep on talking about bridging the financial gap in the MSME sector, which I think which is contributing 27-28% of GHG emission. They always struggle to raise capital all the time. Can they provide capital to MSME segment? Okay, we keep on talking about blended financing. Can they create blended financing model, particularly by listing themselves or warehousing themselves in the IFSCA? Is it possible? Okay, we need to see that what kind of complementary role this new institution can play instead of cannibalizing the existing institutions. So for my personal opinion, they should provide risk capital all the time. They should take adequate risk so that commercial players can come in. If they are not providing adequate risk and become another lending institution, it is not playing the role, the kind of role the industry is expecting. I'll stop here. Thank you.
Thanks, Lavanya. I think some really great points. And what I gather from what you've said is that we have to decide what the role this particular institution plays, either as an orchestrator uh, or as a provider of uh, capital and risk mitigation through its own books, or a mix of both, right? So floor is open. We really need to understand, what role this actually can play in the long run, which actually complements the existing institutions. So Ria, over to you. I think we are done.
Shantanu, we
I don't
have
think so. We
one
have
question.
any. Yeah,
Yeah, we
we
have
have
one
one
question in
question.
the chat box. Yeah, yeah.
Right. So Mehul has posted a question. How does the debt equity ratio affect the infra sector, as all new tech deploying companies are mostly existing companies which might already be having high debt to equity ratio? Uh,
I'll
I
take that
think it's
question.
straightforward. Yeah, Sheetal, you can.
Yeah. Yeah, so see, debt equity means higher debt equity will mean higher leverage, and that becomes a concern to anybody who is looking at the viability of the project. So, also, there needs to be some equity for the promoter to show the skin in the game, and that's why the commitment. But one point which can be looked at is while debt may be high, what is the characteristic of the debt? If it is a much longer tenor, then there is more push into the cash flow, better DSCRs, or some other structure, some kind of a subordination or some support which has or moratoriums, which can help in such kind of a case. So high leverage becomes a problem, but one needs to look at the structure of the repayment, or if there are some options in between to refinance at a lower rate and better structure based on covenants. So that's how it is. So it's similar. Some sectors will typically naturally have more leverage given their capacity and uh, expansion requirements and capital intensity. But that is where it is, and that is how it gets funded also. I mean, I think the funding agency will also understand this and kind of structure the debt that.
Can I just add
Thank
to
you.
that,
Want to come in?
Shantanu?
Yeah.
Yeah, no, I just want to very quickly add. I think we have seen several times the refinancing route. You get the asset commission and then you kind of move forward. So you have institutions and a lot of the original open access, a lot of original rooftop, which came, was done through that route, right? So you had institutions who were willing to take pre-commissioning risk, given the nature of the project, and then you would end up structuring on lines that Sheetal talked about. So I think and we also need to recognize at some level, if it is a existing incumbent company, there has been a long relationship with the current banking. Indian banking has thrived on relationship banking for the good and for the bad. And so that also colors some of this outlook.
I think we don't have any other
We don't have
questions on
any
the
more
chat.
questions. Yeah, yeah,
So over to you, Ria. Thank you so
yeah.
much, Upendra, Sheetal. Great having this conversation with you guys.
Yeah, thank you. Thank you so much. Like I really, really enjoyed this conversation because we really got a lot of good insights. And I think we also got a lot of insights on what some of the future pieces of research can be, at least from our side. So I would really like to extend my heartfelt gratitude to Mr. Upendra Bhatt, Lavanya, Sheetal, and Deepak ji has already left the conversation. And of course, Shantanu, thank you so much for this, moderation. Absolutely fantastic insights which we have derived today. Thank you to the participants who have, been patient to hear all the technical things which have been involved in the conversations. So thank you so much. We wish you a very happy and nice, joyful evening. Thank you.
Thank you so much. Nice.
Thank you.
Bye bye.